There it is, Anthony.
What a time to be alive.
You've heard the quote, right?
What quote?
May you live in interesting times.
I've never heard that quote before in my life.
Well, you need to look it up.
Well, here we are.
Yeah, the whole goal is that you live in a time that is of interest, whether good nor bad.
Is this some Star Wars stuff?
No,
Okay.
not at all. But I'm a huge fan of Star Wars.
Never. I've seen one episode or one movie. That's all I got.
I was going to say episode. It's
Episode 1.
right. Okay. Well, that makes sense. Yeah. Okay.
Oh, and this is Freightonomics.
Freightonomics.
Ladies and gentlemen.
Yeah. Welcome to this week's Freightonomics, where we combine an analysis and stats of the freight industry with macroeconomic analysis and hopefully bring a little bit of clarity overall to how they both relate, interact, etc. Also give a little bit of explanation over what you can do about it, especially those involved in the industry itself. But hopefully we also give a little bit of insight to those outside of the sphere. You know, there's always this this population that thinks like, well, I'm in my finance industry or I'm in my, retail industry. I work at Target and maybe I don't know, everything that's going on because I have the specific job or the specific detail. But you know what? We're all connected in some way. Transportation to retail to health industry, all of it connects in a way. Mortgage industry.
Would you say
housing.
it's a chain?
Oh my goodness. Here we go. Some form
a chain that is connected.
Some form of chain.
That supplies the world.
If there was only some term for it that we could use.
I'm just wondering.
Yeah. So yes, welcome to this week's episode of Freightonomics. Now, Anthony, we have had this year has been basically marked with the coronavirus.
Yeah.
Like we are now in the coronavirus era of existence.
Yep.
My own personal take is that this is the flu. And it's already out there, and we're pretty much, there's nothing we can do. There's nothing we can do to contain it. It's already run its course in China. It looks like China has stabilized in terms of new existing cases. They're right around 80,000. They've been that way for a few weeks now. They feel like they've got it under control.
80,000.
80,000 in terms of confirmed cases. Of course, that doesn't mean that there's 80,000 specific cases out there. There's probably several hundreds of thousands. That they just, the sample size is biased towards those who go to the doctor, who report it, etc.
And what China reports?
That too, which we talk about. So the big concern, of course, in the world is how does this impact the global economy? A lot of our 401ks have had a nice roller coaster of a ride over the last week or so.
Exciting, if nothing else.
Yeah. Up $1,000, down 900, just all over the place. And I was talking to Seth Holm about this impact the other day. Now, this is, of course, very relevant to anybody out there. And I'm, know Seth Holm in terms of financial market experience. He actually he was a money manager at a,
hedge fund.
At a hedge fund.
Yeah.
So he understands the psychology of it. And that's a key term right there, the psychology of it.
Big time.
I think we all know that the market is not necessarily as rational as we would all believe or like it to be.
Right.
The stock market is what I'm speaking of in particular. So as the Dow Jones flexes up and flexes down, I liken it to the emotional mood swings of my 7-year-old. And it's, and it's one of those things where, and I asked Seth, I was like, can I get a little insight? You were there. You're the guy that's trading. You're the one hitting the button every day.
In the trenches.
Over whether or not to hit, buy or sell. And he was basically explaining, like, you know what? The days of it being a pure value position are pretty much over with. I mean, we all know that the market moves way more erratically than the actual value of a company. Walmart doesn't lose 10% of its overall value in a single day. Nor does it gain 10% of its value in a single day.
Right.
So we know that the market itself is moving a little bit more emotionally or outside of logic than we would prefer. So he said, yes, there is a little bit of that going on, of course. A lot of the market will react to certain pieces of information more sensitively,
right,
if you will, than others. And, these are at the end of the day, as much as we want to program everything into algorithms, program everything into computers and robots and automate all these things, I myself used to automate as much as I could of my job, just so I could get away from the routine day to day. But at the end of the day, there's a human aspect to everything that we do. There's a human aspect to all of our transactions, everything that we talk about, as much as we want to be buried outside of that sentiment and feeling that I so much want to get away from. It is a real variable in this equation.
Right.
So it's one of the hardest equations to solve. And a lot of these, one of the smartest people in the country are sitting in desks right now programming algorithms because of that sentiment.
Right.
And they're trying to capture how much does that feeling move the market up or down. And in that movement, people make and lose money.
Right.
And that's the way the market works today. So like it or not, that's the way it is. So a lot of this emotion or this movement in the market is simply somebody saying, you know what, if I lose a lot of money, regardless if, you know, Peter over there loses money too, Seth sitting in this chair, he's losing money. All their clients are sitting there saying is, I'm losing money. I need to find somebody else, even though everybody else is losing money.
Right.
They start thinking about, they just don't like to lose money. Yeah. No, none of it. I don't like to lose money. Do you like to lose money?
Not particularly. No,
no, I don't like to.
Not
lose
usually.
Money. So yeah, so it's creating havoc, and it's because simply we have so much unknown with a situation like this. We talk about black swans, and black swans are, of course, those things that occur. They're anomalous events outside of the standard seasonality, cyclical nature of the overall markets, overall just world.
Right.
You know, these are the things that you can say that every year it's going to be spring. Temperatures are going to warm up. Every year it's going to be, you know, summer. They'll warm up even more. Then it's going to cool off again. These are predictable events. We know that the direction is going to be kind of a curve. It's going to be lumped in there, and there's going to be normal seasonal patterns. People are going to go out and they're going to plant in their gardens in the spring. They're going to need water in the summer when it heats up and it gets drier. And then in the fall, they're going to plant some stuff.
Right.
You know, this is a seasonal algorithm that you can program relatively easily. Now, the peaks and valleys of those seasons are obviously not as predictable. There's a lot of other variables. I'm oversimplifying a bit.
Yeah. I mean, even sometimes the turning point, because I think a lot of times when people think of economists, they forecast. And I think the easy part of forecasting is the direction. Because when it's going down, everyone jumps on like, hey, it's going down. The tricky part is that turning point. Being able to predict when that uptick is going to go.
When is it turning? How high is it going to go? How low is it going to go?
Yeah.
This is if you look at the freight market itself, if you look at spot market averages over the past several years, you cannot apply any year to the next year. You can tell in June rates go up.
Right.
You can tell in December, November rates go up. But they are dramatically different every single year. There's no one year that you can overlay on top of each other and say, 15% increase in June. You can't do it.
It's never the same. It rhymes, but it's not the same.
Yes, that's a good analogy. I like that. Yeah, it technically rhymes. So let's give the people a little bit of an update on the coronavirus situation. It is the story. I think a lot of people may have fatigue, and whether or not you believe it is a significant event or not, whether we're overreacting or not, that's another story. But let's just stick with what we know about this thing. So we just had Greg Miller, brilliant writer.
Amazing.
Yeah, report on how basically China has recovered almost all the way to where they were pre-coronavirus, pre-Chinese New Year levels. Now, Chinese New Year, of course, the holiday that occurs once a year, early in the year in January, February. This year it was on January 25th. And traditionally, a lot of Chinese workers, basically exit. They don't work anymore for about a week. It takes them a couple of weeks to get back up to production. It takes them it takes several months for this cycle to move through the international shipping supply chain, if you will. By about late April or so, we have fully cycled through Chinese New Year, and it's literally only 1 week of existence.
Right. This
year, of course, we're expecting a lot deeper trough, and we already have seen it in our international imports data. It has troughed significantly deeper and a little bit longer than we would expect it, and we're not even through. We're not even scratching the surface really of the troughing period.
Right.
So we won't see the end of this until mid to late April. Now, Greg Miller in his article, if you look on FreightWaves.com, basically China cargo flows rapidly return to pre-coronavirus levels. This is a really good article. You should check it out. And it talks about how basically China has returned to business as usual.
Yeah.
And this is from a Cargo Metrics company that uses a lot of deep analytics to figure out exactly what is happening in the industry. Do you want to give people a little bit of a rundown? What you took away from this? I mean, I myself find it quite fascinating because I wasn't expecting this. Mm. I didn't think, we read the Maersk article last week and they were thinking 60, 70% by this point in time in terms of return to action, about 90% by mid-March. But he's saying at this point, their cargo metrics data is saying that they're already back up.
Yeah. And I mean, as you mentioned, you can go check out the article, but some of the big points is that he mentions that the cogs of global trade are already kind of grinding back into motion. And one of the big things that I really saw here is that we're seeing this on more of an upstream effect, right? So I think the biggest impact, even because this was during Chinese New Year, so I think the biggest impact for China isn't going to be necessarily the industrial or the manufacturing side. I think the biggest impact is going to be that consumer side, because Chinese New Year is a big consumer time frame for them. That's when a lot of active purchases go on. And so because there's this disruption, they weren't able to make those purchases. There was a lot of self-quarantining. So I think the big impact for China is going to be on that consumption point. And I think we're also going to see that with maybe luxury stocks that are operating in China when they see earnings a lot lower within that region because there was a lot less consumer activity. But so Greg really does a great job breaking down this in this article, just going over some of the exports from China and how they're really starting to ramp back up. Now it's going to be, there's also going to be some disruptions that may kind of come online, whether that's going to come from the demand aspect of manufacturing and production and things like that. So that's still unseen whether that demand is going to be strong as a ramp back up. But being able to see that they're already kind of ramping back up, I think gives hope to other regions that have just now be newly impacted by the corona outbreak, to see that where the origin is already starting to kind of taper down a little bit. So I think that's a really good takeaway there. But a lot of the data that we're seeing now it's kind of like a little bit of a bright spot, wouldn't you say?
Yeah, no, it's really good news, especially for the trucking industry. In terms of whether or not we were, there probably will be an impact to the overall volumes here in the next couple of months. But the big unknown was how deep and how long will that exist? And that's obviously a big question. It won't manifest itself for another couple of weeks or so inside the trucking industry. We are already, from our data, what we're seeing, a lot of that is outbound volumes out of Los Angeles, Ontario market. Yep. This is a big freight hub for the United States. A lot of imports come in there, but there's also, if you look on Google Maps, I know I've said this before, and I kind of get lost in the Google Map aspect because I love technology, especially the way that it materializes, and it's in the most simplistic forms. And just looking at a map of Ontario, California, Fontana, the area of Los Angeles, you could just see, and you can zoom out, and you can see just a sea of warehouses, sea of DCs sitting in that area. And it's due to the fact that a lot of our biggest shippers, the biggest accounts in the country, your Targets, Walmarts, Americold, any big, think about a big shipper, and they probably have some presence there. Now, some of them may be hidden in terms of overall warehousing. You have Prologis out there that, basically specializes in warehousing for customers. So they'll own the warehouse itself, but they'll lease out their space to customers to have, that allows them to flex up and down in terms of overall warehousing ability. And you can see it in the Ontario area where there's just so much warehousing activity. So when I look at Ontario, California, I'm basically looking at the trucking industry. I'm looking at a few months forward. If there's a lot of outbound volume coming out of there, then I can assume that the trucking industry is doing well. And, you know, a lot of carriers know this. I mean, as much as of a pain, and I know we talk about it on Freightonomics, it's a little bit of a pain to operate in California.
Yeah.
But you do, because you have to, because there's just so much freight volume coming out of there. Ontario, California, the biggest single outbound freight market in the United States in 2019, roughly 4.5% of the total freight volume in 2019 originated in Ontario, California. That was a little bit anomalous in terms of the whole trade war impact.
Right.
You know, China, you know, a lot of shippers obviously pulled in a lot of freight, buying them a little bit of time so they could change their supply chains, redistribution networks, et cetera. Carriers figured this out, kept that market pretty action-packed with trucks.
Right.
A lot of volume coming out of there last year. And that has simply dried up. It started drying up about mid-November, early November. And then a few of the other bigger port freight markets in the United States, you know, San Francisco, Savannah, New York, New Jersey. New York, New Jersey, a little bit of an anomaly because a lot of that freight did go over to the East Coast because they were changing their sourcing. So a lot of that freight moved from, you know, going straight from China to Los Angeles to, you know, Ho Chi Minh City to New York.
Yeah.
Because it was a 2-day shorter journey, a little bit less on the cost side.
Yeah.
So, you know, there is a little bit of buried interaction in there that we can't really see cleanly, but you can see if you look at Savannah, Houston, Los Angeles, some of these bigger markets, then in about September, October, this volume just drops off.
Yeah.
And a lot of that, most of that is due to the trade war.
Yeah.
And this has taken a lot of carriers off guard.
Yeah.
You know, as you're building a network as a truckload carrier or as an LTL or something like that, you become dependent on a certain situation of freight supply. And, you know, say you're accustomed to, you know, 50 loads a day coming out of Los Angeles, and all of a sudden it's 25.
Yeah. Yeah.
Like
a huge decline.
You have been building your network based on getting 50 trucks a day going into Los Angeles, and now all of a sudden you only need 25. So all those inbound loads become backhaul moves for you.
Right.
Backhaul obviously is the thing that's, you know, you're trying to get out of. It's where you have less freight coming out than going in, et cetera. But it's also a return trip in a lot of instances. But anyway, the point being is that you are out of balance now. And so this dramatic fluctuation in the freight network, or the freight, I guess, footprint of the United States, can really disrupt the, you know, a carrier's ability to operate.
Yeah.
And of course, in that, you have this implied decrease in capacity.
Yeah.
And that increases your spot rates.
Right.
That increases your contract rates.
Yeah.
If carriers no longer want to go into LA as much as they did, say you're heavy Dallas into LA somehow, I don't know how that works, but you know, all of a sudden your rates are going to go up this next year because carriers don't want to go into LA as much as they did last year. Yeah. So that's the whole use case for, you know, looking at freight volumes in the country, looking at supply chain operations, et cetera. You know, you really need to have this impact. You really need to understand the impact of the global economy. I mean, the coronavirus you know, could disrupt that in the short term, but the real you know, issue, in my opinion, over the last year has been the trade war and how it has created this bubble, this fluctuation of volume coming out of Los Angeles, et cetera. And
one of the things you mentioned was like the inventories and warehousing and stuff being pulled forward. I had a chance to chat with the good folks over at that put together the Logistics Managers Index. Professor Zach Rogers and Dale Rogers.
Great name.
Yep, Zach. He spells it Z-A-C. It's a little bit different.
I'm all right with that.
A little edgy, you know.
I'm all right.
But I had a chance to chat with them. Of course, LMI, very similar to the Purchasing Managers Index. It's pulled together by Colorado State, Arizona State, Rutgers, University of Nevada, Reno, Rochester Institute of Technology. I think that's all of them.
Give them all their credit, Anthony.
Forgetting one or two. My apologies. But one of the things that it's broken down in components. And one of the things that they saw was, one, the LMI moved down in the most recent month for February. And the other thing is, for the LMI, it's not like the PMI where it just kind of captures the manufacturing component. It also captures consumer sides as well. So we saw that inventory levels dropped below 50. So it's similar to PMI. So inventory levels dropped from 54.2 to 48.4.
So for those of you out there not familiar with the LMI, it's a diffusion index based on surveys of 300 to 400 supply chain.
Yeah, a couple hundred.
Yeah.
I won't say North American, but I think just U.S. Logistics executives.
Yeah. So when they say that their inventory is dropping, that means that they literally don't have the inventory in their warehouse that they had before. So that means that they are now slightly undersupplied.
Yeah, and warehouse capacity, that's another metric that they measure. So it went from a 54.7 to a 60.8. And so this is the first time in the LMI history that it's been above 60.
So they have lots of capacity. So that means basically the warehouses are emptying.
Yeah.
And what that should lead to is that more imports are needed and demand is outpacing supply.
Yeah.
Correct?
Correct.
All right. Look at me.
Show done.
Yeah. So for those of you out there in the transportation sector, that means that you may actually see, and I didn't think that this impact was going to be quite as significant, and we still have yet to see it fully materialize, which we won't for the next several weeks. The recovery from this impact of Chinese New Year, coronavirus, the inventory levels, they're going to need to replenish those because all these warehouse managers they keep a certain percentage of inventory and they want to keep a certain amount. Now, you track the business to sales inventory and it's about 1.4. Is that accurate?
I think that sounds about right.
So 1.4, which means that they have 1.4 months of inventory available for sales. Now, we expect that number to fall because that is a pretty lagging indicator. It's not. Yeah, we don't normally see that for a few months, and it's recorded by the Bureau of Economic Analysis. There we go. Look at that. So if they have 1.4, we're expecting that to go down probably into the 1.3, 3.5, 3.6 area, because we just haven't had a lot of replenishment coming from overseas. 22% of our imports come from China?
Yeah.
Is that right? So what this means is moving forward here in the next, several months, and we're going to see an impact of coronavirus and all this for several months.
Right.
This is not like, tomorrow, once the news stops reporting on it, everything's fine again.
Yeah.
We are going to see a ripple of this happen because we were talking about coronavirus in January. It's March.
Yeah.
And we still have not seen 1% movement in truckload volumes related to the import volumes declining, and they've declined a lot.
Kind of reminds me of IMO 2020, but it's coming. We've become so good at reporting information in this country, in this world, I should say. We've become so accustomed to this immediate gratification that we just anticipate so quickly, and we expect these things to happen so fast that we've become biased to thinking, well, nothing happened there. Yeah.
And then
it's already tomorrow. Nothing's happened.
Yeah, and then 4 weeks later, here it is.
Yeah.
And that's what happens. It takes time for these things to happen. A lot of these shippers, before Chinese New Year, we saw a spike in imports, a lot of volumes, a lot of shipments, et cetera, coming in front of Chinese New Year. So what that did was it built up inventory levels.
Right.
Well, it takes about 2 to 3 weeks for those shipments to get across the water. We're not an airplane ride from Shanghai or Shenzhen. Right. It's pretty far across the water, and then it has to go into warehousing, et cetera, and then it gets transferred and trucking, yada, yada, yada. So the topic of the day, Anthony, that I'm going to dive into for this, for those of you that have been watching, listening, et cetera, we are basically building up this 101, this Freight 101, if you will.
It's like an encyclopedia.
Yeah. It's basically, what is this? These are the type of things that I was asking questions to when I first got in the industry. Maybe you're in a specific segment of the industry. Maybe you're not in the industry at all, but you want to know more about what a specific item or topic is. And this week's topic is freight forwarding.
I can't. Also, I forgot to mention, you might see me, if you're watching, looking down at the computer screen often. I am monitoring LinkedIn and YouTube. So if you want to jump into the conversation, feel free to comment, send us a message. If you've got a question or just want to throw in some input, we are here. We are watching.
Yeah. So anytime you want to jump in, ask those questions. We love those. But the whole purpose of this show is to educate. It's kind of the how stuff works for freight.
Yeah.
At this point. freight and economics, if you will. And so bring them on. So this week we found, I just thought that this was extremely topical and very relevant. We have Henry Byers here, but he's not available today. I wanted him to be on the show today to really dive in a little bit deeper, but I'm going to do my best to fake it.
Best Henry impression?
Yeah, my best Henry impression, and grow 6-7 inches and become extremely intelligent.
He's a smart guy.
All at once.
He's a smart guy.
We're not going to dive into the full on, deep analysis that he can do, but I just want to make this an approachable subject. And the whole topic today is to figure out, what is freight forwarding? Mm-hmm. What does that mean in the overall transportation industry? I know I didn't necessarily have a lot to do with it back in my life, but I knew that it existed, and we did have some level of tangential interest in what happened there.
Right.
And a fallacy of mine is that I just didn't know that it existed in the extent that it did.
And that's one of the things you chatted about earlier, right? Is like you could live in your world, in your lane, and not really be affected by, and think you're being affected by this whole supply chain, right? And
exactly.
So this is, like, I think, a good step into, hey, this is how it's going to affect other areas of transportation.
Yeah, exactly. And just knowing the basic workings of it might help you in your day-to-day job in general. It would have helped me tremendously if I'd have just known a few basic principles of this. That way I wouldn't have had extensive conversations learning about it, and then I could get into my analysis or whatever I was doing. Today's topic is freight forwarding, and this is extremely relevant to today's market. And in the next coming months, you probably want to know about it.
Yeah, yeah.
So freight forwarding. Traditionally, and a lot of people think, freight forwarders are just brokers. It's a little bit more complicated than that.
Yeah. So is this more so skewed to the international community, Zach?
Quite a bit so.
How timely.
Yeah, and that's why I decided that we need to cover freight forwarding this week, because we have, there is a lot more. There's going to be a lot more prevalent here in the next couple of weeks. Freight forwarders are different than, your 3PLs that you hear about. You work at a brokerage, you're an intermediary.
Yeah.
And you intermediate freight movements. That's the only level of similarity between freight forwarding and a 3PL.
Gotcha.
After that, it is a totally different world. So freight forwarders specifically, to put it in its simplest terms, they handle all the transactions moving freight from origin to destination anywhere.
Yeah.
So it's multimodal. So that means it could go on an airplane, truck, rail, name another way. Yeah. Name
truck,
another way.
Rail, air.
And a ship. Just the biggest one, a ship. They basically say, okay, so Target needs to ship something across the ocean. And they say, you know what? I don't have the relationship to get that LOL surprise doll from Shenzhen.
I see what you did there. Relationship. I see what you did there.
From Shenzhen to my warehouse in Atlanta, Georgia.
Yeah.
So one of their biggest value adds is the fact that they have international agents, and they can get that freight from China. They handle all the paperwork, which, again, one of the biggest differences is the amount of paperwork a freight forwarder is willing to deal with.
Gotcha.
They have to handle all the customs, the warehousing. They don't necessarily own any of it.
So that's a big part of it, right?
Yeah.
Owning the freight and then owning the goods that you're hauling or transporting throughout the country or globe.
There's a legality issue here, and I'll get into that here in a little bit. I don't want to dive too deep into that just yet. But basically, you need to get it from a warehouse in Shenzhen to Atlanta. They will say, all right, we're gonna send a box truck to go pick up your LOL surprise dolls, to get it to the warehouse at the port of Shenzhen. Shenzhen then, they handle all the documentation, all the, the paperwork that says, okay, this freight can leave.
Yeah.
And go across the ocean and exit China. It's going to be okay. We've inspected it. Also, it has all the stuff that you've asked for. So they get through that process. So the more you're handling something, the more complicated it gets.
Right.
There's a lot of handling, and there's a lot of bureaucracy involved in getting something outside of a country into another country.
Yeah.
So they handle all of that. So they say, gets on a box truck, goes to the port, gets from the port into a warehouse, from a warehouse, then it gets loaded onto a container ship, and then from that container ship, it goes across the ocean. And then they handle the paperwork about it entering the United States. Let's just call it the Port of Los Angeles.
Yeah.
Port of Los Angeles then has to have some sort of customs clearance process.
And in Los Angeles, in California, surely the regulations are loose around there.
Not at all.
Okay.
So, so again, there's a lot of political bureaucracy involvement into getting this freight into the country, out of a country, especially from China. I don't know if anybody's heard about the trade war, but we talked about it a few times.
Yeah.
So there's a lot of stuff involved in getting that freight across the ocean into the country. Then, once it gets into our country and it says, okay, you're clear, documentation, it will then get on the rail, on another truck, etc., get to a warehouse, get to, whatever it is that that Target said, hey, I want you, freight forwarder, to get it to whatever point.
Yeah.
It could be final destination. It could just be a warehouse.
Yeah.
It could be a holding facility that Target wants it to go to. It doesn't necessarily matter. So essentially a freight forwarder isn't just like, in the way that it's different from a 3PL or a broker. A 3PL or broker is basically like, hey, I need this shipment going from Los Angeles to Dallas on a truck. I have a full truckload. Freight forwarders can handle, and again, brokers can handle less than truckload, et cetera, all sorts of small shipments. But they're basically saying we can get it, whatever it is. High value is also another thing. There's more high value product coming on freight forwarders than there are on brokers.
Sure.
They're saying that they can get it whatever means necessary to that destination in a very specific time frame.
So with 3PLs, some 3PLs, they have, I've heard the term asset based. So with the freight forwarder, do they have assets? Do they have warehouses? Do they have trucks, ships, planes?
So here's the thing, they can,
Okay.
but they typically don't.
Gotcha.
Freight forwarders are just that, forwarders of freight.
Yeah.
Now, some of them, and again, there's a little bit of discrepancy here. So, I think some people out there have heard the term NVOCC, non-vessel owning common carrier.
Yeah. Yeah.
They actually perform a lot of the same operations of freight forwarding. But there's a big difference. So freight forwarders do not own the freight.
Okay.
NVOCCs own the freight.
Gotcha.
And this is a technical legal thing. This is a very important difference.
Yeah.
Huge difference. Non-vessel owning common carriers will, they technically act as if they are a carrier, but they don't own the transportation equipment. So they don't own the ship. They don't own the truck. What they do is they lease a portion of that ship or that truck. And then in that same means, that means that they, anybody that's been in freight for a little bit knows that if you're a carrier, you're technically taking possession of whatever it is that you're transporting. That means that you are legally liable for whatever happens to that while it is in your possession.
Yeah.
Freight forwarders do not own any of the freight.
Gotcha.
They're helping you with the process of transporting the freight and moving the freight to where it needs to go, but they don't own it. Therefore, you cannot hold them liable for anything that happens to that freight in that process. You have to go after the carrier. And so that's why there is a very important delineation between NVOCC and a freight forwarder. Just like a broker in the United States, they don't own the freight.
Right.
If something damages your freight and you've handed it off to Echo Global Logistics, you're going to have very little luck going after Echo.
Yeah.
You got to go after the carrier.
Right.
And that happened to us back in our day too.
Yeah.
We were the ones liable.
Yeah.
Even though it was, but we're ultimately responsible. We're holding the freight.
Right.
NVOCCs, since they own the space on the transportation equipment, that's their space.
Yeah.
So they're liable for it.
Yeah.
So that's a very important, difference. So
one of the things that you like, so just kind of backtracking here real quick, because you went over all of the things that needs to happen, right, for freight forwarders, from the origin through all the loopholes and not loopholes, but hoops that they have to operate through, and then going into a whole new country, all this stuff. What's insurance like?
It's a nightmare. It is an absolute nightmare. So a lot of the freight forwarders are, like I said, it's more than just transportation.
Yeah.
It's also warehousing, storage, various other intermediary operations. So they literally take over the entire transportation of whatever product you are trying to transport. They own it.
Yeah.
But they don't own it.
Right. Right.
They own the process, but they don't own the freight. And so therein, you are trusting them to put that freight on somebody that you are trusting.
Right.
Otherwise, you're going to be very unhappy because they're going to damage it, or it's going to be late, etc. But they are responsible for the entire service of it, but they don't own it. They can't be sued for any damages or anything like that.
Gotcha.
So, the insurance part of it is obviously a big deal.
Yeah.
And there's insurance providers that specialize in these intermediary insurances just to make sure that there is an extra layer or an extra buffer between the two. But again, most of that is, since you do have extra layers of it, insurance costs are going to be a lot higher, but also a lot of the freight is a lot higher in value in general. Most people, again, freight forwarders have networks of agents and people internationally. NVOCCs will literally operate within themselves. So they'll own all of it. And it's typically, somebody domestically that just they'll literally own the containers.
Okay.
The 20 and 40 foot containers, they'll operate those. But they won't necessarily, like freight forwarders won't. They won't own the containers. But they'll handle the packaging. So everything that happens to that freight, they're responsible for. Yeah. But they don't own the vessels, that it transports on.
Right.
Which is kind of confusing to people. And it really, I understand why. That's a very confusing concept.
Yeah. And I remember one of the other things that you went over in one of the previous episodes, I think it was probably our truckload versus LTL, when you're handling the product more often, that becomes more and more of a liability for things to go wrong, right? And so I'm sure that's also a factor into the whole insurance cost, because I can only imagine if you have a product that's coming from China and then is going into a warehouse and is changing modes potentially, that there's more hands being put on that product, more liability.
Not just more hands, but also higher risk in terms of international exposure. You have different regulations in other countries than you do here.
Right.
Especially now. I mean, we've got so much contention, and especially involving China. Our political side of things has been very anti-China over the last year or so. So that means that there's more increased chance that your product may not make it over to the United States in the form that you think that it's going to be in.
Right.
So that's going to increase your risk.
Right.
So you have to think about everything, especially on the insurance side. They're not simply there to say, we're going to just mess over the customer.
Yeah. Yeah.
It is literally an algorithm that says you have X% chance of losing this freight or damaging this freight on this load. They then put that they turn it into a financial figure, and that's what it is.
Gotcha.
And it has nothing to do with the fact that, again, a lot of it has to do with the value of the freight.
Right.
Because obviously the higher the value, the higher the cost of replacing. But again, everything is an odds game to them. And
Gotcha.
if the odds are too high, you're going to pay a premium for that.
Yeah.
So it's that simple and that basic. They're not simply out there price gouging, over what's going on, but it is a legitimate amount of risk, especially involving in today's climate where you are talking about moving freight from a place that is disease infested, according to the media.
Yeah.
Even though there's 80,000 confirmed cases in
it's quite a few billion.
They've got a few billion over there. Again, the reporting numbers we know that they're a little bit soft. We can go ahead and assume that. They're soft here too.
Yeah.
But again, that's going to be an increasing factor moving forward. Again, what happens this year too, it doesn't go away.
Right.
Like now we have had a black swan event involving coronavirus. We've had this. Insurance costs are going to go up.
Yeah.
That's part of the equation now, because it is now a factor. Because now that it's happened, they now have substantive evidence that it can happen again. Just like hurricane,
has to be priced in.
It has to be priced in. So our costs are going to go up. Every time that we have one of these disruptive events, expect your costs to go up, for good or bad. It's just part of the equation. It's part of life. Hate to be dad here, but
That's how things work.
It's how things are.
Yeah.
That is kind of depressing. But, you know, the freight forwarding aspect of things is far more complex than the simple, you know, than a freight broker who is saying, like, I'm going to go ahead and handle, it's basically the freight brokers, the 3PLs in the United States handle, you know, domestic transportation, LTL, truckload, can be rail, intermodal, et cetera. But it's basically saying we're going to handle this piece of freight moving from Los Angeles to Dallas, and it's going to be handled in this window here-ish.
Yeah.
We're going to pick it up. We're going to do this. Freight forwarders, they're a little bit more specific. They're a little bit more time definitive. They tend to be more, you know, on time in terms of like, or more, I guess, cognizant of the time that they're transporting it in. That's why that they involve the airlines and the air freight industry in that, because a lot of that freight does need to move very specific windows. You got pharma, electronics, et cetera, that are involved in that a lot more often. But yeah, they are, you know, if you have to simplify it all the way down, the freight forwarders are far more international and the freight brokers are far more domestic.
Yeah.
And there's a far more moving parts in the international sphere than there are in the domestic one.
Yeah. And one of the things you chatted about earlier when breaking this down was because I'm thinking of all the things that has to happen for a freight forwarder. You need to be able to leverage quite a network of relationships in order to have a continuous, smooth operation.
Yes. Yes, you need lots of people. You need lots of things involved. That increases your overhead. That increases your costs, increases your risks, et cetera. So you're going to have to pay more for that premium.
Yeah.
It is not a very, again, and you don't have control over all the parts.
Yeah.
Like I said before, you have agents sitting over in China that are going to handle one part of the transportation, one part of the warehousing. You're going to have different regulations over there than you have over here. It's a very complicated process.
Yeah.
Not quite as simplistic as saying, I need a truck moving from St. Louis to Chicago today.
Yeah. Yeah.
And I need it moving, you know, I need it picked up today, but I need it delivered, you know, Thursday. That's expedited freight, but at the same time, it's not, you know, it's not as complicated in terms of, you know, figuring out who's going to handle it. You know, you call a list of carriers.
Yeah.
Whereas with an international shipment, you call the shipper, you call the government, you call the warehouse provider, you call the port, you call the transportation provider domestically, you call the port domestically, you call the insurance provider domestically, you call all these. It's literally just a plethora of entities that you have to deal with. Whereas in the United States, in a freight brokerage situation, it's very simplistic.
Yeah.
Not
Imagine starting a freight forwarding company.
It's a lot.
Yeah.
And again, the NVOCC gets confused with that. They do own the space, so there's a legal, you know, that is a big deal in terms of, you know, overall cost, overall, you know, what you are paying for.
Right.
They're going to handle a certain part of that. That's not necessarily the same way that a freight forwarder would. So, fun facts about freight forwarding.
About it.
So, you've seen the notes. I'm not even going to pretend.
Let's pretend.
When do you think freight forwarding began? Ignoring what you know.
And ignoring what I know. Zach, well, technology is, I mean, I'm thinking global expansion. Maybe freight forwarding began around 1950s, 40s?
No.
No?
No.
Earlier?
Earlier.
Really?
So think about transportation.
Yeah.
This isn't like international trade is not a new concept.
It's been going on for a while.
It's been a while.
Yeah.
But think specifically about transportation in more of a industrial modern era.
The Industrial Revolution, especially.
We're getting there.
Yeah.
We're getting there.
Yeah.
1836.
Okay.
In England, the Thomas Meadows Company. Now, I'm not saying that they are the first ones, but they are some of the earliest recorded versions of modern day freight forwarding. And that's because that arrived right around the time of the advent of steamships and rail. Because you have this multimodal, you know, aspect of things. You have the ability to, you know, keep goods safe and intact. You have, like, England is, of course, expanded. You have colonialization around the industrial era, I should say. And they are now, you know, there's an interest in keeping those goods safe
Yeah.
and intact over long distances outside of your realm of control. England is a very small country in terms of area.
Yeah, yeah.
But traversing the Atlantic Ocean, that's no small venture.
Right.
So 1836, that was basically the first, I guess, recorded instance of modern day freight forwarding.
Interesting. Early.
Yeah. What do you think about that?
That's pretty impressive. I mean, it makes sense, you know, if you link it to the Industrial Revolution and really the impact or the influx of steamships and rail and all that stuff coming online. So yeah, it makes sense.
Yeah. So I feel like we've covered that pretty extensively now.
Yeah.
If you don't know what a freight forwarder is, the difference between MVOCCs, call us. Yeah, I don't know.
Yeah.
Email us, whatever.
Reach out.
But you know, it is going to be a more important aspect of things, especially moving forward, because it takes so much time for this freight to move through the system. I think that's one of the big points. That's one reason I wanted to cover this today, is because everybody's thinking, I haven't felt anything yet. My contracted freight volumes are doing fine. I'm doing well. Nothing's impacted me yet. I read all this stuff on FreightWaves. I don't see volumes going down. I don't see them going up significantly. So it's a non-event. Give it a minute.
Yeah.
We are not yet. So we're literally, 4 to 5 weeks away from Chinese New Year. Something everybody was already planning for on the shipper side.
Right.
They built up their inventory. It was already high because of the trade war. They were already happy with it. Especially, you can see that clearly in November freight volumes out of LA. They fell off a cliff about 20 to 30% in a single month. So they had plenty of inventory. So there's an inventory level, just like the LMI is presenting there. It's now falling below what probably several are thinking is an acceptable level.
Right.
But now they have to place those orders.
Right.
And then they're going to have to come back. So depending on how much inventory is available in those warehouses, we're now going to see some sort of lag or delayed effect in the freight market in general. People might be panic buying or panic pushing freight. So it might cover up that impact a little bit. I mean, you have to think about this. How many masks did you order last week?
Quite a bit.
Yeah. I mean, you have a whole room dedicated to just...
Yeah. Designer, different, prints, patterns, all of that.
There's so much that has happened around this. Anytime people get excited or anxious or whatever, there is panic buying, all this kind of stuff that happens that may actually cover up a lot of what we've seen already.
Yeah.
In terms of like diminished freight volumes. It's just going to be different freight.
Yeah.
So again, we're not seeing it. We're seeing actually a pretty positive sign in terms of overall freight volumes. We're roughly 1.5% up year over year in terms of overall freight volumes. Okay. Contracted freight volumes are doing well. Week over week, we're up about 4.4%.
Yeah.
Which is a pretty good number. Again, we're in March. We're in early March.
Yeah.
We're starting to see that spring season pick up. I cannot find in all of our data, the only data that I can see clearly, and of course, Mike Bodendistel, our rail expert. Bodendistel.
Get it right.
Sorry. Sorry, Mike. The rail volumes are down significantly out of LA. They are down inbound to a lot of cities. But you know what the crazy thing is? I was looking at this the other day. Atlanta volumes, inbound rail volumes are down significantly since November. Which
so
again,
that precedes.
We're talking about the trade war.
Yeah.
The trade war has had more of an impact than coronavirus to date to the trucking market.
Right. Yeah.
It's like we get caught up in these moments of, news headlines, et cetera, but it's not materialized yet. I'm not saying that it's not going to show up in the freight market at all, but right now to this date, it has not showed up at all in the freight market, except for in the rail, because they're obviously much more exposed to international freight movements. International loaded containers down about I think they're down 10% year over year.
Wow. If
you compare the two Chinese New Year periods. So yeah, they're down and they're still troughing. International shipments are down quite significantly. So we're seeing it took about 12 days for the international imports to trough out last year, and they dropped about 15% in 12 days. This year, they've dropped about 20% in 15 days, and it still hasn't seen a bottom.
Yeah.
So international imports down We're still waiting on that pick back up.
Yeah.
Greg Miller's article saying we're already done. Wait for it here in the next few weeks.
Yeah.
Which is good news, and I think this is really positive news. That means that if this is right, if this cargo metrics data is accurate, which I believe it is, by the end of May, we'll be 100% through the at least supply side of the freight. What happens on the consumer end, I'm going to leave that up to you because you're in touch with their feelings.
Yeah, sure I am.
You know, and I think we should dive into that here a little bit, just to say, like, you know what, the consumer is what drives a lot of the freight in the United States, and so far, I don't know if we have seen anything that has showed that they are losing interest outside of stock market volatility.
Nothing just yet. Also, Paige Finch on LinkedIn, we see you, says produce season, $. We're getting there. And then she also says, then why can't technology promote the success of such a large portion of transportation transactions? I'm not sure if there was like what that was in reference to, but I'm thinking transportation transactions and technology can only do so much when you're kind of when you're operating from country to country, right? So that's not going to be a bypass scenario.
No, technology can only take you so far. It's not going to change the underlying value of what you're offering.
Yeah, yeah.
And you know, if there's not a huge demand for it, then it's not going to, you know, transactions are one thing, and then there's the value of each transaction that's another.
Yeah.
You know, it's a difficult process. It's a complicated process in terms of freight forwarding, how much somebody's willing to pay. You know this, supply demand.
Yeah, good old supply and demand.
And you know, at times you've got other pressures on these things, other variables. There should be, you know, in my mind, that freight forwarding job is worth a lot.
Yeah, yeah.
But then you hire somebody, especially if you're doing this consistently. You hire somebody to specialize in this, and you develop your relationships, and it becomes a very fluid, easy process.
Yeah.
It's those that aren't used to this type of thing, those that don't maybe have the relationship with the steamship lines, the rail, the people that get it across the ocean. Again, and think about the scale of the customer that's involved in that.
Yeah.
They're big.
Yeah, yeah.
They got a lot of buying power.
Right.
So, you know, the Targets that I just mentioned, the Home Depots, they have these relationships. China may have a big influence over us, but we have probably a bigger influence over them because without us, they really don't have the buyer.
Right.
They can produce anything they want, but they're not buying their own stuff.
Sure.
A lot of that stuff's coming over here because they can't afford it.
Right, right, right.
You know, that's the reality.
Yeah.
But yeah, so, you know, I do think the consumer over here, the one thing that concerns me about this overall process is looking for, you know, any kind of sign that we have started to quarantine ourselves. My personal opinion is that the coronavirus is already here. It's already in most places, most states, whether or not reporting it or not. We don't have the testing capabilities. I know they talked about, they shipped out 500 tests to San Francisco.
Yeah.
That's 500 tests to San Francisco. That's nowhere near the amount. So they're only testing
I haven't
people.
been tested for coronavirus.
Yeah. So, and it looks like the flu, tastes like the flu, smells like the flu.
Is it the flu?
It, you know, all accounts and purposes, the only thing that's separating this from the flu is the fact that we have a vaccine for the flu and not for this.
Yet.
Yeah, yet. And people are just going to be more susceptible to it in general, therefore inflating some of the numbers instances. So eventually I believe it will go through the country.
Yeah.
And not that it already hasn't. I mean, I myself, if I get sick and have 102-degree fever, I'm going to lay on my couch. I'm just going to lay there for the next 3 days.
Yeah.
I'm not going to the doctor because I don't feel like it. And they're just going to tell me, come back in 5 days or call me in 5 days if you don't get better.
Right.
Because that's what happens. So.
And then you start blaming people that flew into the office.
Yeah. And I will. Idiot.
No one in particular, you know. We got people flying in and out every day. But one of the things you mentioned was the consumer reaction. And Zach, one of the indices that I love to look at, consumer confidence, was one that came out not too long ago. So consumer confidence came in at 130.7, according to the conference board. So it missed expectations of 132.6. So it wasn't as high. It was still an increase, but just not as high. So it really shows that there's still a strong reading in January. And so this really kind of covers I like this because the coronavirus is already introduced, right? Mm-hmm. It didn't ramp up, and the most recent stock action that we just got through, that we're still kind of going through now, is still underway. So that's going to be, I think, baked into the next release. But this at least shows that there is some resilience. It's some hesitance, but there's some resilience there. You know, it increased, but not quite as much. Right. It in decline. There might be a little slight decline next month. I don't know. But it does show that there was still an overall strong reading. I think that's one of the things we saw throughout 2019 was that there was a pretty resilient consumer after the trade war talks, the Twitter stuff. Consumers, if it's not impacting them, their underlying conditions are still stable.
And we
jobs.
had a great retail season.
Yeah.
Walmart might have missed expectations, but we still had a pretty good retail season. We saw it in the trucking volumes. Mm-hmm. Maybe didn't translate specifically to as many, robust or spot rate movement as we would have liked potentially, but it was still a pretty good season.
Yeah, yeah, and that's a big takeaway here, is that it's all really being underpinned by employment rates. Even the demand for labor we're seeing is, got to watch those job openings. So that's a nice gauge for demand for labor, because that declined the last 2 months.
We're running out of time, Anthony. So I want to make sure that we hit one thing.
Yes.
And that's that's a 50 basis point drop in the interest rate.
Yeah. The
federal funds rate.
Yeah.
What do you think about that? I need a hot take.
So hot take, I mean, it's going to make big ticket purchases more affordable for the consumers. That's a plus. When we're looking at especially things like interest rates or mortgage rates and things like that. Woohoo! More.
But that's already doing really well.
Yeah. So there's that. So I mean, that's going to be nice. Capital expenditures, all that good stuff. So I think it's good that there was room to drop the interest rate, and that it wasn't dropped all the way to zero or negative prior, because this is something you need to have in times like this in order to manipulate when the economy might be in need of a little bit of a sustained boost,
Right. Little reserve in the back.
Yeah,
you don't want a 0% interest rate. That doesn't do anybody any good.
I'm not coming out the gates flying. I'm pacing myself, But so, yeah, there's that. The other thing that was that 50 number, the ISM PMI.
Right.
So it stayed above 50.1. So just barely.
So that big jump that we saw last month, what was it, 50.7?
It's 50.9 maybe?
50.9, okay. So it only retracted slightly, and it stayed above 50. That's a really 50. Good. That's a really good sign for the industrial sector.
Yeah, and I mean, they have respondents talking about what they're seeing, and they're all citing the coronavirus, of course. So that's, I'm sure, going to be a talking point within the industry, especially for manufacturing. We've had tariff, we had the grounding of the 737 MAX. Now we have the corona. We also had diminished business investments. So there were a lot of headwinds, and there are still a lot of factors playing.
So do you think that we're going to see people overspending here in the next couple of months once we get through the idea that we're all going to take a simultaneous sick day in April or maybe March, depending, because it's inevitable. It's going to go through the country more than likely. Yeah. To what level, who knows? There's that argument about flattening the curve. How impactful is it right away? Because that's really what happened to China.
Yeah.
All these people got sick at once. It's basically like them taking a sick day all at the same time, shutting down production, shutting down manufacturing, and it really had a notable impact to volumes in general. But if we can maybe just move through that a little differently here in the United States on the consumer end, the consumption end, it may not be, that huge threatening event that we all think it is.
Yeah, especially if we get some kind of vaccine situation by then. I think if we see a big ramp up and headlines are just going berserk, there might be a little bit of resistance to go into crowded areas, maybe go into grocery stores. Maybe that'll be a nice little bump up that e-commerce so desperately needed.
Well, they're canceling conferences left and right.
Yes, they are. Yes, they are.
So that's a big economic downturn in that regard. Now, that's a big sign to me that things are, we probably will see some softness in March for sure. I think it's pretty inevitable at this point that we should see softness in March. How that translates into May, June, July, I'm not really sure yet.
Yeah.
But I think that, this first quarter for sure is going to have the initial wave of it. The second quarter is going to have the end of it, but it also may be the beginning of the recovery, which I think actually might have some robustness towards the end.
You're saying a slow start.
I'm saying
and
that
a strong finish.
I'm saying the second quarter or the
second half of 2020.
But I think that we might see a bigger recovery in the second quarter, but it's going to be a rough start to it.
Yeah, I agree. Okay. And we don't really have a debate topic, Zach. I mean, I was going to have my hot take that ice is kind of gross, but you are kind of on the same board.
I've had some gross ice, and I think that it can taint things in general. So, yeah.
What's your take on tap water? I don't drink it.
I don't.
Okay. See, we got nothing this week. We got
can't
nothing.
Debate it. But I think we covered enough this week.
Yeah, we did. We did.
We'll have a hot one next week. We kind of came in hot with the coronavirus.
Speaking of hot, I prefer heat over cold.
I agree.
Okay. So we got nothing today.
See, you know that I do.
I mean, I'll take 125 over 25.
You heard me talk about January.
Yeah, the January blues. Yeah, we don't have anything today. That's all right.
And also the heat will kill the virus and we'll all be happy. So
there we go.
Just like we should be. All right, Anthony Smith. So I think that wraps it up for this week in Freightonomics.
Yeah, shout outs to Emla, the intern, running the show behind the scenes.
Thanks as always. Making us sound good.
Making it happen.
All right, guys. Y'all have a good week.
Emla the intern.
Emla the intern.
Making stuff happen. Look at her there, hard at work.
She's more than an intern.
She is. She's here every day.
She's more than an intern to me.